Hi everyone, Jeff Yastine for Total Wealth Insider. You know, back in early May, I said one group of unloved stocks hit a rare milestone and had become severely undervalued. But, you know, I added that the same sector was about to swing back into favor and offered a great opportunity for contrarian-minded investors. Well, I can tell you, looking back now more than a month later, it sure didn't take long. That group of stocks, consumer staples, which are companies like Procter & Gamble, Campbell Soup, and others, are among the best performing sectors over the past 1 and 3 months. And the ETF I recommended, Consumer Staples Select Sector SPDR ETF, that's the symbol XLP, did pretty well too as a result since that date, as you can see from the chart. But what was the rare milestone that I said was the trigger for this opportunity going back to May 8th? It is dividend yields. You see, consumer staples companies grow slowly, but they pay steady, reliable dividends. But every so often, Wall Street diverts its attention to other greener pastures like tech stocks. And when that happens, consumer staples companies tend to get bounced out of a lot of institutional portfolios. When that happens, of course, their price goes down, but their dividend yields go up. And at some point, they become so juicy that value-minded investors just have to step in and buy. For the Consumer Staples Select Sector SPDR ETF, I noted back on May 8th that its dividend yield had only hit 2.75% or higher 4 other times in the past decade. Those times were in February 2014, late December 2012, mid-December 2011, and March of 2009. And at all times, it hit 2.75% or higher, and then a rally unfolded afterwards as those value-minded investors stepped in and bought. Now we can add a 5th instance. As it turns out, the XLP ETF's dividend yield topped out on May 3rd at 2.98%. And of course, the ETF is now up 5% in value since that date. Now, of course, we have one stock in the Total Wealth Insider model portfolio that's more than tripled the advance of the ETF. But let's just focus on XLP here. Going by historical extremes, I think the XLP ETF could move at least another 10 to 15% higher between now and September. The reason why is because Wall Street is a fickle taskmaster. You know, between January and early May, investors were convinced that consumer staples companies had little to offer their portfolios, and so institutional investors sold them, and that pushed this ETF down by about 16%, while individual stocks suffered even more pain. But then usually something happens to remind Wall Street why these stocks, consumer staples companies, have been around for so many decades. They may be slow growing and quite frankly boring to own compared to, say, the tech sector, but when you experience the carnage of mutual funds all rushing out of the same small group of high-performing tech stocks in the same period of time, like in the past number of days, Netflix is down 8%, Facebook is down 4%, and all the rest. You know, the pain of enduring those sharp losses is usually a reminder enough about why consumer staples companies are good to have in your portfolio. If you enjoyed my video today, make sure to like us on YouTube, Facebook, and Twitter. I'm Jeff Yastine for Total Wealth Insider.